Welcome to Morningstar. Hong Kong and Singapore are top contenders for the title of the most important financial hub in the world, with mature stock markets and a wide array of investment products. But what can we say about the exchanges powering these listings? Are the stock exchange stocks in the two regions worth your money right now? Our equity analyst for the technology sector, Roy Van Keulen, covers the two stocks of Singapore Exchange and Hong Kong Exchange, and he has some ideas. Hi, Roy. First, investors have a range of investment selections on an exchange, but what is the investment case of investing in the stock of the exchange itself?
Yeah, great question. So stock exchanges generally are some of the widest moat companies that we have in our coverage universe, which makes them interesting by and of themselves. And then secondly, they have exposures and drivers which are a little bit different from other companies. They're very much exposed to volatility. And we expect volatility to increase. We think we've had a very good run in the last 30 years of a stable geopolitical environment, support of central banks. We've had globalization, which kept a lid on inflation. And with current trends towards more deglobalization, inflation picking up, there is a lot of volatility, and that is one of the core drivers of stock exchange businesses.
So let's go into the two stocks. You recently upgraded the economic moat rating for SGX to wide. So now the rating is the same as HKEx. What are the drivers for this upgrade for SGX?
Yeah, great question. So one of the things that was a concern for a longer time was a lot of the revenue for SGX comes from derivatives compared to Hong Kong, which is more equity trading based. And when you have a derivative, sometimes you've constructed an index yourself, but sometimes you borrow it from someone else, or you license it, and that's what Singapore Exchange did. And the fear there is kind of that who actually holds the power in that relationship? Is it the exchange that provides the liquidity, or is it the license provider that provides the intangible? And that got tested in the SGX Singapore Exchange, when MSCI decided to discontinue its relationship with Singapore Exchange. But it turns out that SGX just switched to a different index provider that provided similar underlying exposures, and that has been fine. They've maintained the liquidity, they've maintained the revenue, so we think that provides strong evidence that the network effect is there and that their business is well protected in that way.
Among the two, which is your preferred stock and why?
So Singapore Exchange is the preferred one. And there are two core reasons. One is its exposure is more towards derivatives. And if you assume that we're going into a period of higher volatility, in the past, market participants may have had a bit of a free ride with interest rates staying low, central banks being supportive. You don't really need to hedge your positions all that much. But when that changes, derivatives are the place to be. So we think derivatives volume is going to be a core driver. And then secondly, there's also the aspect that when you are connected to Hong Kong Exchange, you are connected to China in a lot of ways. And that exposure can be positive when there's a lot of companies in new technologies that are coming that are becoming listed. But it also provides a risk to volatility when we reverse globalization a bit and there become more trade tensions between China and the rest of the world. In the beginning, that's just volatility. That's all positive. But when it when the notch just gets turned up a bit, then it can also become a negative. So that's why Singapore is a bit of has a little bit less uncertainties in that sense.
Thank you very much, Roy. For Morningstar, I'm Caitlin.